Hey, we're back. We're talking about Pfizer today. Obviously, Paul, they got this vaccine. They got approval.
Just today, they got approval.
Mañana.
That's not today.
Oi. If you're in the Bidness Nation, that Patreon tier who's trading or day trading, I'm certain there's some action in there today, Paul. I was monitoring it. Mo is out today, but I'm here with Paul, like the good old days. Paul, Pfizer, we have updated data on our software. Let's look at the financial health of this company. Obviously, their stock price is doing really well. And as a value investor, I'd love to learn if you're interested in this company. Usually, when I see a ticker of this magnitude going in the positive direction, I would assume you're not, but we're going to look at the numbers anyway. If you're wondering if you should be buying Pfizer, some people say, Paul, what is this slogan? Buy the news, sell the blah, blah, blah.
Buy the rumor, sell the news.
Yeah, well, the news is out. So have we missed the boat? Probably. And if you're watching this video in the future, who knows? But let's get after it, Paul.
So first off, what do I need, Seth? I need
fondled?
you to follow us on Instagram because I need my blue check mark or my mom will not be proud of me. So here's the thing with Pfizer, and this is a very important aspect of any time you're looking at any investment. They had big news today. So what's going to happen is the stock goes up and people are going to extrapolate this news for the rest of the time. You've got to be careful on that one because they got approved for a COVID vaccine. So unless you think this COVID vaccine has a market for the rest of time for Pfizer, you've got to be very careful not to overpay for a one-time event. The same as if all of a sudden Pfizer had a lawsuit in which they had a $10 billion settlement and they paid one check for it, right? You would not punish them for the rest of the time saying, hey, you had a $10 billion loss this year because of a lawsuit. We're going to assume you lose $10 billion a year for the rest of the time. Mm-hmm. I'm not saying it's going to be a one-year thing. I don't know how long it's going to be. This is the art of investing, Seth, right?
See.
So today's Spanish day on Everything Money.
Apparently.
By the way, do you know the two meanings of mañana? There are two meanings for it.
One is tomorrow.
Correct.
And another one is something about a banana boat.
The morning.
That's right. Hasta mañana?
Hasta mañana is see you tomorrow.
What's
but
the
like
morning?
en la mañana is like in the morning and things like that.
You see how worldly I am, Paul.
So you didn't take Spanish in high school, though?
Only 25 years ago, Paul.
Did you take it in high school?
Let's look at, we're going to use our 8-pillar analysis.
Our new 8-pillar analysis.
I took 4 years of it, Paul, unfortunately. But we're going to use our new 8-pillar analysis, look at Pfizer, the fundamentals behind the company, and see if the stock price is justified. Paul, let's take a look.
So, guys, our new pillars, the very first one, instead of doing a 1-year PE, we're looking at the market cap divided by the 5 years average earnings of the company, 19.23. We want lower than 22.5. And the reason we went higher than the 19.23, for those of you who are new out there, is as earnings are growing, you have to pay a higher multiple because you're not giving enough value to the first years, which are lower. So this is a check mark so far. Great margin here, by the way, Seth. That's no longer a metric of ours, but great margin.
Pillar number 2 is the 5-year return on invested capital, which is ROIC greater than 9, Paul.
And we have a 9.7%. ROIC is calculated in many ways. Ours is a 5-year average free cash flow based on total asset, total long-term liabilities, and equity. I won't get into that right now, but this shows how well they're investing their money. And since it's a 5-year number, this is pretty solid.
I get ROIC and ROTC confused.
Yes, I thought so. You were an ROTC member.
Pillar number, you're still going.
Well, let's go to the dividend yield right here,
Look at
Seth.
that thing.
They pay a 3.1% dividend yield, which is very high. And that eats up $8.5 billion of their cash flow. Now remember, one thing we talk about in this channel that we try to teach you, dividends aren't always secure, okay? Dividends have to come out of free cash flow. So what you want to do is look at the free cash flow. Last year's free cash flow was $13 billion. So they could cover this $8.5 billion. In the last 5 years, their average free cash flow is 13.3. So they could easily cover, I wish it was a higher multiple, but that's okay. With such a big company, such a large free cash flow, and not much growth potential, it's understood they're probably going to have a bigger payout ratio of their free cash flow going to dividends.
If you like what you're hearing so far, fondle the thumbs up for Paul and just tickle his little belly there before we get to pillar number 3, which is revenue growth, Paul.
Now, this one I'm not surprised about. 52.35 billion to 51.64. That's an X. It's all over the place here, Seth. Look at the last 10 years. I mean, Pfizer's such a big company. It's all about the pipeline. I mean, they're basically down from 10 years ago. So it's kind of hard to get. This is why on a company like this, you want to look at longer term averages of the company. Don't look at year-to-year results.
Profit growth is pillar number 4, Paul.
Look at this number, 8.3 to 13.2 though.
Check, please.
That's a check mark. Probably COVID related is my guess. Now, Big Mama Jamma, shares outstanding. 5.96 down to 5.6, check mark there.
Yep.
So they are buying back shares. And look how far they're down. Look at this. They had 7.48 billion shares. Guys, that means they are giving, when a company is so large, they can pay back their shareholders by giving them dividends and buying back shares. Buying back shares gives them a higher percentage of the company ownership than they did before by doing nothing. You're still gonna own the same number of shares, but now your same number of shares are divided up by less shares outstanding. Therefore, you own a bigger percentage of the company.
If you like the software behind Paul and you're wondering, how do I get this? You can get this as being part of our Patreon, our growing Patreon, Paul. It's been incredible.
It has been. And guys, we made this because our subscribers were saying, how do I get software that you guys use? So we just said to make it. And here's what you get. You get the mobile app, 8 pillars, 30 years of financial data, stock analyzer tool, daily exclusive content, access to Paul, Mo, and Seth, real estate calculator, stock screeners, retirement calculator, and the Big Mama Jamma. We currently have over 5,200 people who are part of our Discord community. They talk about all types of investments all day, including crypto, including the things I don't believe in. They still talk about them. And guys, this can be yours for a measly 84 cents a day, less than a cup of coffee. And whatever you pay, that's your price forever. So if our price doubles, you're just getting yearly increases that are small, 3, 4, 5% to account for our costs. You get all of this versus our competitors. Look at these prices, and you don't even get all of it. So guys, this is a no-brainer. We love it. It's been very successful. So back onto our 8 pillars, right, Uncle Seth?
Yeah, pillar number 6 is current. Oh, no, Paul. This is
new pillar.
So it used to be current assets over current liabilities. This is total long-term liabilities divided by the 5-year free cash flow.
And we want that number to be less than
5.
What that would say is if you took the average 5 years free cash flow, you should be able to pay off all long-term debts in under 5 years. So total long-term debts right now are $63.3 billion. So off the top of my head, it's around 12 point some billion dollars we need in average free cash flow. We go to the free cash flow statement, and the last 5 years, the average has been 13.3.
Perfect.
So they have enough, okay? And is there growth? That's the next question. We went from 13.9 to 12.9. So there isn't growth there over a 5-year period. And even over a 10-year period is down a little bit. But again, these are the things you factor in there.
So Paul, tell us about pillar number 8, the most famous and crucial step of our pillar system. Go ahead, Paul.
So we take the 5-year average free cash flow, 13.3, and we multiply by 20. And that is $266 billion.
That is correct.
What's the market cap of the company right now?
280 billion for Pfizer.
So it's a little bit higher. It's an X, okay? Now, for a company like this, I actually would not pay 20 times free cash flow because the free cash flow is declining and it's not a growing company.
Everything's declining, yeah.
Yeah, so I sit there and say, let's go to the 8 pillars tab. It'll recap everything for you. Guys, so basically revenue growth is down, cash flow growth is down, and the multiple is high. So now, does this mean we're not going to buy it? No, that's with the stock analyzer tool. We have to make our assumptions for the future, and because they are buying back a lot of shares, so we have to sit there and figure out a company that's stagnant can still be a great investment if you pay the right price, right? And a company that's growing can be a bad investment if you pay the wrong price. So that's what we're here to do, use our stock analyzer tool. Pfizer's a big company. I imagine they're going to be buying back a lot more shares as time goes on because their revenue is pretty flat and they want to attract investors.
The final missing piece of the puzzle is now what do I pay? How do I translate all of this into a stock price? And again, Pfizer could be $50, it could be $1,500. That's always confusing for a lot of our viewers, including myself sometimes. So we developed the stock analyzer tool. Paul, this used to be your old Excel spreadsheet that people wanted. You basically put it into software. Our patrons get this, our software users get this, and you're basically making future assumptions about growth, revenue, if they're buying back shares to come up with a price you want to pay today for the stock.
That is correct. And a couple of things I'll go through here before I finish this up. So it's going to give you, I select the 7-year analysis. It gives you your revenue growth. It gives you all your growth numbers for the last 1, 5, and 10 years. Remember, your job is to be conservative as a value investor. If you choose to be a value investor, is to be conservative and pick metrics that you think are low. So for example, I'm going to assume they continue to lose 1% of revenue a year for the next 7 years. Middle one, I'm going to assume they keep the same. The high end, I'm going to say they grew by 1% a year. Share change. I'm assuming -1, -2, -3. Profit margin and free cash flow margin is pretty much the same. They're pretty much in line if you look right here. So they do a good job of keeping their profit and free cash flow pretty accurate, pretty similar. Now here's the deal. PE and price to free cash flow. Guys, this is where I'm going low. Why? There aren't many growth aspects. So I'm going to sit here and probably assume you're not going to like this. 10, 12, and 14 times free cash flow and earnings, and I want 15, 12.5, and 10% return. Okay, guys, so I just hit analyze, and the stock is currently at 48 bucks. So now it's telling me what should I pay? Between 17 and 36. Seems like a long, wide range. But remember, at the $17, you're expected to make 15% a year. And also, we're paying a very low multiple for the company. Now, disregard these scratch marks, but this is exciting for the software. What this is going to do is, it'll show you the price the stock will be in 7 years.
I love that.
Based on your, oh, it's awesome. Based on your assumptions. So you can see how many bagger it's going to be. There's a very popular term about getting a 5-bagger, 10-bagger, 3-bagger. All we're showing is, hey, don't pay too much for the stock. Well, some people might be okay making 7 or 8% of their money. They find a stock they really like, right? Okay, so here, guys, I still think this is expensive. I don't think it should be a 19 PE stock, which it currently is at. By all means, if you believe the growth potential for the company is much higher, then you can pay a much higher price. So for example, I just changed the assumptions of revenue from -1, 0, and 1% growth to 2, 4, and 6. And look at how much it changed the price. It's pretty much a buy here on the high side, and it's not as much of a low price on the middle area.
So if I buy today with your high assumptions over the next 7 years, I can get a 10% return every year.
10% return on my money, assuming all the high assumptions come through.
Yeah.
Now, 6% a year revenue growth over the next 7 years, does that seem aggressive? Well, in the last 10 years, they're down on their revenue. I don't know if it's aggressive or not, but they could have a great pipeline. We haven't done that research. So a few things to look at when doing more due diligence in this company. One, what's their pipeline? Two, what do they have expiring that they currently have that they're selling? Remember, Viagra was a big seller for Pfizer for many years. All of a sudden, 17, 20-year patent goes out, lose a lot of revenue. And third thing to look at is I always want to look at their share buybacks, because as the stock gets cheaper and cheaper, they're going to buy more shares back. So go look at their 10K and read what their plan is for their share buyback plan going forward, because that alone, if they're able to buy back 3 or 4% a year, that could add up. But remember, they're eating a lot of their big free cash flow up with their dividends. So something's got to give. You can't pay a big dividend and buy back shares and pay down debt and do all these things. You have to pick or choose one. I mean, it's kind of like managing a payroll for a sports team. You can't have every star in the world on your team, right?
Yeah.
You got to pick and choose.
If I own this stock, maybe I got caught up in Pfizer, your thoughts on holding or selling high? What do you think?
I don't think based on my assumptions here, the future prospects aren't the best. I think there's better opportunities out there for other companies. We always talk about Biogen. I'm not saying Biogen is a buy at this price, but they have a nice pipeline. They're losing some drugs here soon, but if you're willing to be patient and buy at much lower prices, I think Biogen could be a very, very good stock in the future at much lower prices. Like I'm talking about low 200s, high 100s, and it currently got a big bounce to $330 a share or something like that. So I just think there are better opportunities out there, and that is your job, is to buy better opportunities and look at the investments out there and see what you can buy that's better.
That's our take on Pfizer. Fondle the thumbs up on the way out, and make sure you join the Patreon to get access to the software now. We'll see you guys in the Discord. Patrons, you know I love you. Talk to you next time. Thanks for watching.